With the 10-year Treasury above 5% for the first time in 16 years, let's bring in Komal Sri-Kumar, president of Sri-Kumar Global Strategies, and get his view on what he thinks is going on. Sri, and I know you watch, and we've been talking, we've used terms like untethered and unmoored, and I think that's what you want to focus on, because there could be some, I guess, somewhat disturbing outcomes if the Fed has lost control of its ability to set long rates. We've never believed they could set long rates, but for a while it looked like it was all orderly. They haven't raised rates in a while, and we've had, 80 basis points, 70 basis point increase in the 10-year. That could be troubling. It is to you.
Absolutely. I put out a report on Saturday, Joe, saying precisely that for the first time, you have Jerome Powell, who had never been doubtful as to what he did, even though he has been sometimes wrong on expectations of inflation and interest rates, finally said in his Economic Club of New York talk, as well as in the Q&A session, that he did not know what is causing the higher bond yields. He attributes that to term premiums. The term premiums are not measurable. And therefore, essentially, the Fed chairman comes down to saying, I don't know what it is. And when he said that, I said, we are in completely uncharted territory. Things are going to get worse next week because of the fact that the Fed is totally out of control and they don't know what to do next. So you are absolutely correct. I think unintended consequences are going to happen. I've been saying that on your show for quite some time, whether it be a huge bank failure, whether it should be pension funds losing a lot of money, commercial real estate suddenly worsening, or a CLO, commercial loan market, and levered obligations having difficulty, somewhere things are going to break. And rather than expecting 3 to 6 months, I'm going to say within the next 4 or 5 weeks.
Sri, individuals that are more sympathetic to Chairman Powell's plight have actually said that this was totally Chair Powell's doing and exactly what he wanted, and that when he said higher for longer in recent appearances, that he said it better, or said it in that he actually stimulated yields to go higher. And it was exactly what he wanted, and he kept saying higher for longer, and that he orchestrated deliberately this move up to 5%. And I don't know, we've been saying higher for longer for 7, 8, 9 months. And suddenly we're almost not inverted anymore because of what's happened on the long end, Sri.
There are 2 points in response to your the issues you raised, Joe. They are very relevant. First of all, yes, he wanted inflation, the interest rate to be higher, the yield to be higher, but I don't think he wanted it to go well over 5% as it's done again today, and in that rapid fashion as he has done it. Second, if he is looking for yields to stay that high and to go up that rapidly, if that was his intention, he also must be intending to create a train wreck, meaning that he is going to cause something to crash. And if you tell me that is part of his intentions, then he's right, doing exactly what he wanted to do. But that's not, I'm sure that's not what the chairman wants. What he wants is a mild increase in the unemployment rate. He wants the job opening rate to come down. He wants the inflation rate closer to the target, but otherwise the economy moving smoothly. But that's not what he's going to get. There is no via media between too much excess and crashing if you follow a policy of this kind, when the bond yields, you said they are not controlled by the Fed. That is true. But today he has totally lost control of them and not able to influence them, and that is a lot more serious.
Yeah, I don't know what breaks, and we could do a David Letterman top 10 list. He used to do I guess he was at one point a late night host of a show.
I remember that.
Now he hasn't shaved since he left, I don't think. But but the top 10 list, so it could be commercial real estate. It could be a lot of it. It could be another bank. It could be a lot of different things, but it's scary. But for whatever it is, and there's no guarantee that you'll be right on this, but you could be. But you think that shifts the Fed to easing quicker than anyone anticipates at this point. Like, when do you expect that? So you think within 6 months we could be back on an easing path or a rate cutting path, Sri, within 6 months?
Yeah, Joe, just look at last March to give yourself an indication. We had 3 small regional banks which failed. And immediately, quantitative tightening ended and quantitative easing was put in place. We took the Fed assets back to November of 2022. We set it back by 5 months. What I'm saying is, if that incident could do that, anything like a bigger crash taking place in the next 2 to 3 months is going to completely reverse monetary policy in terms of both interest rates and quantitative tightening. And yes, within the time period that you mentioned, it's clearly when I think it will happen. 2024 is going to be a year of lower interest rates and clearly a much more easier Fed than we have seen so far.
I don't know whether that's good or bad. I mean, we have had the sort of the specter, the possible, Rick has mentioned some things. If you look at a chart, much higher rates could be in the cards than what we're seeing. At least in this case, it sounds like maybe where there's going to be some turbulence on the way, but it would keep us from getting up to, 7, 8, 9%
exactly
anytime. That won't happen, you don't think, in the next 5 years even?
That's exactly what I'm saying, that yes, you may want higher yield to restrain the economy, but you cannot do that without wrecking something, without breaking something within the system.
Because people got too used to that. We were there. There's people 30 and 40 years old, they have no idea that rates can go above like 5%.